So thank you, Mr. Gourinchas, for your time today. Let's just talk about this report that's not very upbeating. And a few things that I've noticed comparing with previous WEOs is that we've been highlighting this divergence between developing and developed economies. But now with this Russia-Ukraine situation, do you see this divergence or this gap between these two country groups growing further? And if so, what does this mean for long-term global economic development?
Well, thank you for having me. It's first this divergence that we've noticed between advanced economies and emerging market and developing economies started already during the pandemic. So this is a phenomenon that precedes the war, and it's related this sort of the scarring effect that we see on emerging and developing countries is related to largely to less support for these economies coming from their government and also lower vaccination rates. Now, the war itself is not playing neatly on the distinction between advanced economies and emerging market developing economies. So it's not affecting overall the picture that we see there. And we had a figure in our WEO report that sort of illustrates that, because it's really driven along the lines of what happens to energy and food prices. And within the group of emerging and developing countries, you have some energy exporters, food exporters, and you have energy importers and food importers. And this is where we see the divide between the countries with growth projections have been revised upwards and those whose growth projections have been revised downwards. So overall, it doesn't change the aggregate picture, if you want, but within each group, there is more heterogeneity now.
Mm-hmm. Also, another question, which is also related to the energy price you just mentioned, is the inflation in many countries. And now with the Federal Reserve entering rate hikes period, do you see inflation or just overall global monetary situation tightening, putting extra pressure on developing countries? And do you think this might alter the big picture in some way?
Yes, I mean, the tightening in interest rate and increase in borrowing cost, what this will do is it will reduce the fiscal space in many emerging and developing economies. But at the same time, while in the past, whenever advanced economies would start on a hiking cycle like the one we've been seeing over the last few months, this could potentially create a lot of turmoil in emerging market economies with massive capital outflows, currency depreciations, increase in spreads. We haven't seen much of that yet, and in part because a number of emerging economies are, in a sense, better prepared. They have adjusted their economies. Many of them have started tightening monetary policy on their own, even before the US Federal Reserve, for instance. So far, we haven't seen as much of a financial dislocation coming from the hiking cycle in emerging markets.
Mm-hmm. I think recently the IMF said that the sanctions on Russia is diluting the role of dollar globally. And this report also highlights that this fragmentation could cause a certain level of some kind of anti-globalization trend. Like, can you elaborate a little bit on that? Do you see anti-globalization becomes the theme of maybe in the near future?
It's certainly a worry that we might evolve into a world in which we have different competing blocks with different reserve currencies, different technology standards, different cross-border payment systems, for instance. And that would be really bad news for the global economy. It would undo a lot of the gains we have achieved in having a fairly integrated global economic system, one that is organized around a certain number of rules. So we are worried about that scenario, and we think that a transition to a more multipolar world, which is bound to happen at some point, needs to be managed so that it doesn't devolve into separate blocks that are not trading or interacting with each other.
Another point that the report makes that attracts my attention is that it says that the Russia-Ukraine situation is challenging the global order that's been dominating the international economic relations for the past 70 years. Can you elaborate a little bit on that? In what way specifically the Russian-Ukraine situation is challenging the order?
Well, it is challenging because it's for the first time, if you think about the nature of the sanctions that have been put in place, for instance, by some countries against Russia, those sanctions have gone beyond just restrictions on exports of goods from some countries, the US or European countries to Russia, but they also have included financial sanctions. And among the financial sanctions, there have also been sanctions against the Central Bank of Russia, freezing some of its international reserves. And so there is if you think about the world in which countries are holding reserves as some sort of insurance against shocks that might happen, whether it's a crisis that happens elsewhere, or whether it's a natural disaster, or there's a financial crisis, the reserves can help countries buffer this type of shocks. Now, all of a sudden, you realize that those reserves might not be available. That might lead to a reassessment. There was a lot of speculation early on, immediately in the weeks after the war, that what this meant is that somehow now countries need to diversify reserves away from, for instance, dollar reserves or euro reserves. And we think this is where this notion of fragmentation comes in, where countries would sort of try to sort of only trade on old reserves, have reserve holdings, and maybe have payment system with countries that they see as allies and friends. And we want to warn against a trajectory, going too far along that trajectory, because again, there's a potential for efficiency losses, for supply chains that are not as resilient. We have a chapter in our report that illustrates how supply chains actually have been quite resilient in the pandemic, despite the very severe shocks that they've been subjected to. And so undoing a lot of this would create volatility, would reduce standards of living, and would make the life of everyone harder, and would also prevent us collectively from addressing some of the common challenges we have. If we have a world with different blocks, how can we really address climate change, for instance?
So moving on to China, China's Q1 GDP data just out at 4.8%. Can you give us a more thorough outlook about China's economic perspective?
Right. So this number came out yesterday. So of course it's not included in our baseline forecast. In some ways, it is sort of in line with what we were projecting for China for 2022, which is a 4.4% growth rate, a slight revision of 0.4 percentage points. At the same time, in that report that came out yesterday, there are some signs that the Chinese economy may be softening and slowing down at a fairly accelerated rate in the March data in particular. January and February were quite strong. That's why this number came above forecast. But the March data seems to indicate a significant softening related to the lockdowns in various parts of the country, including Shanghai. And so here, really what we are saying, and we've seen this morning with some announcement from the authorities in China, there is a need for both fiscal and monetary policies to respond and make sure that the Chinese economy remains on track, that the People's Bank of China has announced some measures. There might be a need for more fiscal measures to support economic activity.
Mm-hmm. And the last question, you touched on this point already. In face of some greater common challenges like climate change, the world needs to cooperate together. But the reality is that, with everything's happening, countries need to prioritize their own policy goals. So how do you think that at this time that we're in, countries can still preserve their multilateral cooperation?
Well, it's challenging, and we highlight this in a report that somehow the more you do to help your vulnerable populations, maybe it doesn't leave as much space, or if interest rates are rising because of inflation, then again, it might make things more complicated on the fiscal side and therefore for climate mitigation. But it's easy to get lost in the short-run objectives and not keep track also of the longer-run objectives. And there are ways in which we can do things that are helpful both for the short term and the long term. And let me give you just one example. For instance, one of the things we are seeing right now is an energy crisis. Obviously, we have high energy prices, and the response to an energy crisis is to find ways to produce more energy. Now, this energy in the short run might not be renewable type energy. We might have to rely on sort of more traditional forms of energy, but it's okay in terms of addressing the energy crisis. But it might also work against the climate objectives that we have. So we have to acknowledge this, and whatever we do that might be going against the climate objectives in the short run, we have to make sure that we offset that in the medium to long run so that we can still meet the net zero objectives. And there are ways of doing this that we mentioned in the report so that we can try to move in parallel on both fronts, addressing the short run energy crisis, at the same time keeping track of the long run climate objectives.
All right. Thank you very much, Mr. Gourinchas, for your time and the insights.
Thank you, Gabriel.